Principles of Accounting 1, Chapter 1, Short Exercise 8. We're looking at the preparation of financial statements. We have Randall Company, and it says that he engaged in activities during the first year of its operations that resulted in the following. We have service revenue of $4,800, expenses of $2,450, and withdrawals of $410. Then it says additionally, the year-end balances of selected accounts are as follows. Cash has a year-end balance of $1,890. Other assets have an ending balance of $1,000, accounts payable $450, and owner's capital $2,450. And so what it wants us to do is it wants us to prepare our three financial statements. The order of the preparation of three financial statements is important. We have to prepare the income statement first because we need to calculate the net income that is necessary in order to prepare the second financial statement, which is a statement of owner's equity. So we can't prepare the statement of owner's equity without first solving for net income, which is done on the income statement. After the preparation of the statement of owner's equity, we can then prepare the balance sheet, because on the balance sheet we need to use the ending owner's equity that we get from the preparation of the statement of owner's equity. So therefore it is important that all three statements are prepared in a certain order. So the first one we're going to prepare is our income statement. Now our income statement summarizes the income and the changes in our income for a company throughout an accounting period, generally a year, and we're looking at year end here. So the basic equation that we get from a single step income statement is total revenues minus total expenses gives us our net income. So that's what we're going to be looking at here. Now service revenue, a $4,800 in service revenue was our revenue account. So I'm going to click on the down arrow and choose service revenue, and I'm going to put in $4,800 for the amount that was given to me. Then we have total expenses, and in this example we're just using total expenses. In future examples you'll list out each expense individually. So the total amount of all of our expenses is $2,450. So revenue minus expenses in this case gives me net income, because my total revenue, the amount of money that I earned minus the total amount that I spent, gives me a net income because my revenue is larger than my total expenses. So I can use the calculator built in to Cengage, or I can use a calculator on my own, and I'll take 48,000 minus 2,450, and I get 2,350 for the amount of my income statement. Okay, so again, it is necessary for me to prepare the income statement first because I need that net income amount in order to prepare the statement of owner's equity. So now we move on to the statement of owner's equity. Now the statement of owner's equity shows the changes in our owner's equity over an accounting period. So we have to take into consideration what our owner's equity was at the beginning. We have to add in any net income, add in any additional investments that were made, and then subtract out any withdrawals that the owners made in order to determine our ending owner's equity. So we're going to choose here. It says that here gives us the option. So we want our beginning owner's equity. So December 31st, 2013 is the same as January 1st, 2014. So that's the amount that we're going to start with. So our owner's capital on that date was $500. Okay. Then we take into our net income for the year and we add in our net income, and our net income was calculated up here. So I'm going to carry down that $2,350. And when I add those together, my beginning owner's equity plus my net income for the year gives me $2,850. So now I know what my subtotal is. Then I can scroll back up here and see if there's anything else up here that happened, and it said I had withdrawals. So I'm going to need to subtract out my withdrawals on the statement of owner's equity. So less withdrawals. The total amount of withdrawals was $410. So now I'm ready to calculate my ending owner's equity, which will be my owner's capital as of December 31st. So I take my subtotal calculated previously minus the amount of money that was taken out by drawing, and I end up with $2,440 for my ending capital. Now again, it's important that I prepare the statement of owner's equity second, because I need my owner's capital in order to filter down to my balance sheet. Now the balance sheet, you'll notice only here is the balances of all of our accounts as of December 31st. Whereas we scroll up and look at these accounts, they have for the year ended. They're a summary of things that have occurred throughout the year, and the balance sheet is just looking at one day, one particular time, and the balance of all the accounts at that time. So the balance sheet is also your accounting equation. It's going to show that the accounting equation is in balance and that assets will equal liabilities plus owner's equity. So when I begin to list my assets, generally I list them in order of liquidity, which just means I list them in the order of how easy they are turned into cash. So my most liquid asset is cash because it's already cash. And the problem, if I were to scroll up, tells me how much my cash was. And it says that my cash is $1,890 and my other assets are $1,000. So I'm going to put into my cash, I'm going to put in the $1,890. Then I'm going to put in my other assets, which could consist of accounts receivable, supplies, equipment, prepaid insurance, different things like that. But this problem just kind of has them all lumped together as other assets for a total of $1,000. So when I add those together, I'm going to have the total amount of my assets, which is $2,890. So now I'm ready to look at my liabilities. And if I were to scroll above, the only liability it listed was accounts payable. So I'm going to put in my accounts payable, and the balance of my accounts payable is $450. Now, so my total, my only liability was accounts payable, so my total is also $450. Now I'm ready to put in my owner's equity. And it's important to note that on the balance sheet, we want our ending owner's equity. Okay, so we're going to put in owner's capital. And if I scroll up, you'll notice I have two owner's capital, and the whole point in doing them in this order is to calculate my ending owner's capital, which is to filter down to the balance sheet. So my ending owner's capital is $2,440. Okay, so if I take my $2,440 plus my total liabilities, I end up with $2,890, which now you can see my accounting equation is a balance. Total assets, $2,890, equal total liabilities plus owner's equity, $2,890. So I'm going to click the check my work to make sure we have everything correct, and just to kind of show you what it looks like after you use that function, which you can only use once. So it gives me the green check mark showing me everything's okay, and then sometimes it gives me a little bit of feedback. So an important thing to know here is the equation for the income statement. Revenues minus expenses equal net income. Then we had my statement of owner's equity, and everything is correct there. And it also gives us an equation for all of you equation-minded individuals. Beginning balance plus net income minus withdrawals equals our ending balance. Then we have the balance sheet, as I mentioned as we went along, which is our accounting equation, total assets equal liabilities plus owner's equity.